Thank you, Andrew. Yeah, as you said, we don't have a moderator today. We're going to have a bit of a discussion between us about what is potentially quite a controversial topic, um, which is framed mostly around the US administration. But I think a lot of the conversation, we're going to steer away from that, at least later on, as to the impact on Asia. But perhaps let's start with sort of, I'm talking about the US administration energy policy. Is it really, we have this drill baby drill, or as it's been called here, drill, drill, drill. Is that, and we are seeing some immediate short-term effects in the US, particularly on offshore wind, on sanctioning of LNG export, which was this week for, I think it was what, 1.2 million tons a year, I think they're looking at. So domestically, there's quite a big shift, and that is also filtering through to the financial markets as well, and particularly amongst the banks. Yeah, I guess U.S. energy policy. What do we think?
What do you think, Viggo?
No, I think there's a lot of hot air coming out of DC, and you know, there's a willingness and a wish for you know, low energy prices in the United States. That's just to reach out to the Midwest and the general electorate of Donald Trump. I think realistically speaking, it's more hot words than anything that's going to transpire over the next couple of years, unless you, of course, get more of the OPEC buy-in for it. That being said, U.S. super majors who are now, you know, dominating the Eagle Ford and the shale industry, they have very little incentive to get low oil prices and natural gas prices. So there's definitely you know, a tug of war between what the administration wants and I think what the industry is willing to look for. I mean, low oil prices, low natural gas prices is not something that Exxon and Chevron and Conoco wants over the next couple of years. Quite the contrary.
Yeah, I agree with that. I think there's a sort of fundamental sort of conflict in Trump's policy, as you say, like low prices for the consumer, high prices for the producer. I think the one thing that he might do that actually will work for everyone is deregulating and unlocking gas infrastructure around, particularly in the, as you say, the shale regions, the oil shale regions. Because doing that, I mean, I think gas is essentially sort of negatively priced for a lot of oil producers in the US at the moment. So if you're able to find a way of monetizing it, even if you've got low prices on the oil, suddenly the economics improve. So that might be something that he can do. But I think a bigger point just to consider is how long it actually takes for these you know, these policies to play out, and I think there will be some low-hanging fruit and little things around the edges, but I'm a little bit skeptical about this drill baby drill policy sort of turning into sort of significant volume additions on the oil side. I think the sort of the LNG sort of miracle, if you like, that the US is pushing and has been for a while now will continue to grow. I think partially just led by the fact there's a massive discrepancy between gas prices in the US and the rest of the world. Yeah, and I think the other thing just to think about is, you know, who's actually going to be in power in 4 years' time. Much as the Democrats would love to tell you, Trump's never going to leave. I suspect a change of government will possibly sort of, you know, the same thing happened, right? You had Biden, then you had Obama, then you had Trump, and then you had a Biden, and they sort of all unwound one another's energy policies, and so there is obviously a risk of that happening again in 4 years' time, which would put the brakes on a lot of the legislation that Trump tries to put in place over the next 4 years.
And I think that timing is key because, you know, we're all well aware of the amount of time it takes for an oil company to explore, develop, and sanction a discovery. is longer than the current president terms. So in a way, it's a little bit misleading to focus solely on the current administration. There may be short-term incentives, but longer term, I'm hopeful that those who are actually making the investments aren't making knee-jerk reactions to what may be in place now and have to look longer term. But generally, there is a push towards kind of general energy security, particularly in Europe as well, and Japan, Korea, the price of LNG, which does mean that demand needs to be the demand is there. The price needs to be moderated for there to be secure energy, but also at a relatively affordable price. And so a lot of the incentives to transition, or I guess it goes back to what was said before, the sticks about transitioning, they're not being lifted, but they're being moderated a bit, so that the penalties on fossil fuel demands aren't quite as, and therefore the transition won't be as quick as we thought it was going to be. So because of the focus on energy security, and I think that's generally seen not just in the US but everywhere else as well.
I think my comment to that is, Martin, I think there was a general flaw in the thinking that we could get out of natural gas and oil and gas as quickly. So it's not about carrot and stick. It's about developing two things at the same time. You know, we can have as much as we want of sunshine here in Singapore, but there's no way renewables will replace natural gas in Singapore. There's just not, it's not possible. So we would then have to rely on energy coming from somewhere else, either through cables or through pipelines. And that's just going to take time to build all these pipelines and cables and so on, and integrate the grids to handle electricity from, you know, variable production and so on and so forth. So generally speaking, this carrot and stick, I mean, the Germans tried to shut down their nuclear reactors way too prematurely, and look what the kind of mess they put themselves in. So, you know, China is still building a lot of coal power plants. It's not necessarily because they're not building out renewables. On the contrary, they're spending more on renewables than the rest of the world. But the coal power plants are there in emergencies and as a base load when it's, you know, the sun is not shining and the wind is not blowing. So the EU sort of narrative on this, I think, was flawed from the get-go, to be honest.
Yeah, it's quite an interesting question, Martin. You know, does Trump's very counter-cultural policy on energy and the fact he's got over 50% of the population of the US to sort of come on board with it, does that mean that the energy transition that we've all been talking about for the last decade, does it get undermined somewhat? And I've got sort of two views on this, because I think, as Viggo says, there's a bunch of people, particularly people who actually understand economics and energy, who've never really bought into the energy transition as it's been portrayed to the majority of consumers, let's say, through the media over the last decade. These people would call themselves pragmatists, and you know, you've seen them talking at events and writing books and all the rest over the last 10 years. I think what's quite interesting is that as Trump and his political movement has normalized this viewpoint, it's become politicized. And the result of that, actually, funnily enough, is that those people who would consider themselves energy realists or pragmatists or, you know, economically sort of broadly sensible people are going to start looking like far-right extremists. And so I have this view that, funnily enough, the brakes aren't really going to get put on some of the less economically sensible ideas, let's say. And I feel like there's going to be a sort of equal amount of economic regression in terms of policy from a lot of the world.
You mean in terms of investment in renewables?
Yeah, well, I think there's a bunch of stuff that's economically regressive that's done by certainly my country, Britain, and some of its European allies, and I don't think that stuff's going to stop just because the sort of the Trump MAGA movement has drawn attention to some of the weaknesses in those thinking, those attitudes.
Yeah, and that probably brings us to the question of sort of voters, and then I guess a little bit political activism when it comes to the energy sector. And there has been quite a lot of that in the last few years in some of the more some more developed countries. So in the UK, in Australia, France particularly. That's which has affected the ability to explore and produce fossil fuels. For example, who was it? Shell has a couple of projects. There's in the North Sea in the UK, which are currently sitting in the courts and environmental procedures to look at those. And a lot of that is driven by the activism, which seems to be kind of more diverging from the majority voting in a number of these countries. So essentially ending up as a kind of more separated public sentiment as to around what essentially comes to energy security and energy transition. It's quite weird how that seems to reflect what's happening at the kind of the macro level as well.
But what you're saying is the majority of the electorate is starting to think, okay, it's a good idea to have domestic production of hydrocarbons, right? Yeah. And the political class is still sort of teetering on the edge of banning this stuff.
But there's still a number of voters who are going, but we want green.
But I think this is it. I think energy has just become politicized, right? Like that's the reality. And I think when you terrify the whole world of the threat of carbon on their existence and their children's existence and the future of the world, it's very difficult to sort of put that genie back in the bottle and just say, we want to have jobs, we want to have low energy prices, that's good for our economy. So, let's do that whilst trying to do it in a clean and sensible way from an environmental perspective. You can't do that anymore because what I just said sounded pretty far right by Western political standards. That's my view, at least. And that's why I think this drill baby drill thing, it's going to become a political attitude, which is going to be seen by one side of politics as the only way to go, and the other side of politics as just pure evil. And the reality is actually that there's probably a sensible route to take down the middle that no one's going to be able to run on as a political energy agenda. That's my very cynical view.
And I agree. It's a little bit actually like Tesla's, which is bizarrely at the opposite end of the spectrum, which is being the Trump drill baby drill supporters are pro-Tesla, and the other voters are anti-Tesla, which is completely at odds to the green transition.
And Trump's policy is sort of anti-Tesla as well, despite the fact that he personally has just bought one to support Elon. He's also he's taken away incentives for EVs. Yeah, which
No, but should we move to offshore oil and gas, and particularly kind of across Asia? And I think we're all fairly united in saying new exploration is very bullish. There's a number of new opportunities, and not just, across Asia, but also the rest of the world. But Viggo, on the drilling side, you're slightly ahead of where we are in the time scale of development. What are you seeing on?
No, listen. Southeast Asia continues to grow, right? It's the fastest growing region, and people do want to turn on the lights, right? They want to send their kids to school and have electricity. So you need to have energy security. We were hearing about LNG prices and shipping earlier on. Of course, it's in the U.S. production is a lot cheaper, but for countries like Thailand, Indonesia, Vietnam, they have natural gas in the ground, sitting in their backyard. They should be drilling and getting that out of the ground, because most of this stuff has actually been discovered for a long time ago, and it's relatively inexpensive to get it out of the ground compared to other opportunities. So what we're seeing is there's a significant increase in drilling activity in Southeast Asia taking place over the last, I would say, 2 years. Gulf of Thailand, certainly active. Vietnam picking up. Indonesia still lagging, and then there's, Malaysia is also doing pretty well. They just need to sort out the things with Sarawak. But over the next couple of years, we do see quite a significant amount of new projects, FIDs being made, developments, platforms being built, and that's primarily to replace existing barrels that are, depleting at the moment. There was earlier this year or during 2024, Saudi Aramco released something like close to 40 rigs. A good chunk of that has been soaked up by Southeast Asia. So absolutely, to your point, in this region we do see a lot of drilling, but mainly on existing fields. In the next couple of years, though, we would see drilling on new fields coming online.
But I guess, does that then mean that we're looking more at marginal discoveries being exploited more? And then the pressure that we face, and I know some of our peers in the room face, is just there's a lot of pressure on pricing on production. The infrastructure cost, the capital cost, and finance cost is too high to make a lot of this viable. So cheaper solutions need to be found. And perhaps actually one of the areas you've exploited more, Charles, is that area.
Yeah, sorry, I don't want to sound really negative about everything. I agree with Viggo. There's obviously a lot of demand for the product. There's definitely a sort of economic realism in Asia that we kind of got to keep going on the current trajectory with regard to oil and gas. I just think the sort of the infrastructure, coming to your point, that you really need in order to have a proper boom. I mean, which is what Drill Baby Drill would sort of imply, right? If you were going to go for that sort of policy in Asia, you need the supply chain, you need the financial institutions, the banks, equity investors, debt investors. You need everyone. Must have said something very shocking. You need everyone to be committed, and the reality is that, look, this last 10 years it's more than that. It's 15 years basically. It is 10 years. It's basically since the oil price crashed in July 2012, started crashing. The whole industry has been decimated, and you had the oil price crash. You had a bear market for 5 years. Then you had COVID at the exact same time that Russia and Saudi fell out over managing oil markets. So it's a sustained period of low prices. Then ESG comes in. I mean, it's like the oil majors started reacting to it probably in around 2018, 2019. It's about 5 years ago. It's not actually that long ago. And then the banks caught up, and just the entire ecosystem of oil and gas has just been completely decimated, basically. So I think to be, rewinding 10, 15 years to the sort of time when Shell spent $7 billion drilling wells in the Arctic, which I think was 2012, and it's not that long ago, which is kind of what you need to have boom times, I would have said. I don't think we're ever going back there. So therefore, yes, to your point, this is all around the edges. And actually, yes, one of the reasons that we invest in mature oil infrastructure is we believe that, there's not much competition for it because nobody really wants to touch oil still. B, this stuff ought to survive for longer just because there's nothing really replacing it. Yes, you're getting new build FPSOs to go to Guyana and Brazil, but no one's really spending $3 billion on a new FPSO to exploit a field in Southeast Asia. Someone's going to tell me I'm wrong about that now, but it's not what it was 10, 15 years ago. And so, I think there is value to be gained from owning a tender rig company that focuses on the Gulf of Thailand, for instance. You know, I agree with Viggo. I think there's going to be 20, 30 years of business there. And his business, and he'll tell me if I'm wrong, is probably valued on 2.5 years forward, like profit, which is kind of ludicrous if you think about it. So yeah, look, I'm actually very optimistic for those people who are in the industry now. But I think we're sort of, I'm afraid we're dealing with a sort of a declining industry overall, and something that's going to have a significant amount of growth going forward.
No, I agree. Those kind of barriers to entry are getting higher and higher, and yes, there are some new players, and I guess Samos is relatively new, but with the right expertise and knowledge about what risks there are, and some of the other players are taking a more risk-averse approach. Like the larger drilling FPSO companies are definitely becoming more risk-averse, aren't willing to look at some of the longer-term issues that the industry faces, whether it's cost, whether it's regulation, things like that.
Well, and just on that, if you actually look at, you know, who makes up the industry, right? The majority of the world's oil and gas production is owned by NOCs. Then you've got this sort of big 30 million barrel a day slug that's IOCs. And then all the rest is kind of small, scrappy companies who you're not necessarily going to want to take credit risk on. And it's a combination of that and the fact that they're going after marginal stuff. So yeah, it's very difficult. Yeah, we see it quite a lot. People sort of say, "Hey, do you want to finance a floater to go onto this project that, you know, used to produce 5,000 barrels a day, and may do if we get it going again?" You know, it's just no one wants to sort of take on that risk. Whereas 20 years ago, when the market was in a completely different place, they possibly would have done. So it's quite an interesting dynamic. But as I said, I think the market is in sort of reluctant phase-out mode ultimately.
In the longer term, but in the shorter term, still positive, still bullish, still
Absolutely.
looking good, as far as each of us is concerned.
30 years, like, I mean, we're talking a long old time here. I just don't think we're going to revert to some sort of bonanza time for the oil and gas industry.
No, and as you talked about, it's the capital, access to capital. You can't. I mean, the supply chain, everything today, is in a perpetual decline, and that industry is not getting capital, and we're not getting really capital priced correctly. So, over time, that will set it into a sunset.
Yeah, and look, Trump comes in and withdraws from the Paris Climate Accord or whatever it's called. A bunch of U.S. banks say, okay, net zero policies are sort of being scrapped or amended, and all the rest. But you know, it's this. I mean, this stuff takes a huge amount of time to trickle down throughout all of the institutions. And the reality is, we've been going on a route for sort of 10 years where the average investor who's investing their first salary into a pension that, you know, is being invested in a fund that's investing into transition into this unwinding this infrastructure. I don't think it's going to happen, personally.
And to that point, I mean, U.S. banks don't really have exposure to the oil and gas industry in the first place. So, I mean, not even in the oil service space. So, it's not going to really move the needle, to be honest.
Yeah, but we're going to, unless either of you two want to add anything, we'll open it up to the floor for any questions and anything anyone wants to raise, points to make, questions to ask. And if not, thank you.
Does anyone have any questions?
Udaya.
I guess I'll be asking the token question since there's no one else. So BW Offshore obviously listed, Energy Drilling is on the path to becoming listed. Samos has a bond, I guess, listed.
Correct, yes.
And you mentioned there's a lot of activity in Southeast Asia. What about investor interest in Southeast Asia versus Europe, US? How would you gauge those areas against each other?
Maybe I'll start on I think I'll categorize them into different buckets. Institutional investor interest, pretty close to zero, I would say. And that's throughout the value chain, from my perspective. Private money, yes. Often wrapped in a US construct, but private money, certainly.
Just to develop actually the institutional question, I think there's less institutional in the available for public equity investments. There is definitely institutional money for private investments, and we've seen quite a number of transactions across the space from Asian-based investors. But they obviously have to have a more global outlook than purely Asian-focused. But actually, this is where I'd probably slightly disagree with you. I think the retail market on the equity side is fairly minimal, at least for us anyway. So, and actually, I think that's part of a longer history across the shipping space anyway. So if you look at most of the maritime-based listings in Asia, have not mostly been that successful, apart from the longer-term sort of stalwarts of, say, a couple of the Hong Kong companies. But then, I'm saying this from the lens of a Norwegian-listed company. Viggo is looking that direction. Charles, I don't know where your bond is, but
I mean, yeah, I'm coming from a slightly different place. Yes, we have a public bond, but the Nordic bond market, I think, isn't a great illustration of sort of public market appetite for investing in anything particular and anywhere in the world. I mean, what I would say is that I don't think that our sector ought to be in public hands anymore, despite what these guys are doing. I don't think public investors are interested in it, and I think just sentiment's gone completely away from the market, and they don't understand it as well. So I think it should be increasingly private, or just in the hands of governments who obviously properly understand the sort of security of supply implications of owning these assets. In terms of private equity, I think anyone who is properly private and doesn't have any sort of public sort of contagion anywhere through their ownership or stakeholder structure is completely agnostic about where they invest. And then I think it depends on the sector, you know, and because oil and gas is so cyclical from an upstream perspective. I mean, I think a lot of private capital wants to focus on OECD, and because Europe's sort of killing itself is very much focused on the US. But there's a sort of small portion of sort of Western private capital that it will look outside of the US, and they're fairly agnostic. I mean, I would say that there's a huge amount of geopolitical risk in Northwest Europe, in the North Sea, for instance. You know, the British have changed their fiscal terms 20 times since 2002. Equatorial Guinea's changed its fiscal terms 0 times since 1996. So where would you rather invest? I think that's a true sort of attitude that a lot of private equity would take. Equally, West Africa is quite difficult. So I think you've got quite a lot of interest, actually, funnily enough, in Southeast Asia at the moment. You know, I think you're seeing that because, particularly on the upstream side, asset prices are quite high in Asia at the moment, and a lot of public companies, funnily enough, who, you know, there's this sort of massive conflict, I think, between shareholders in public oil and gas companies and the sort of companies themselves. The shareholders don't really want to be there, and they just want to liquidate, but the companies themselves have just gone through a period of fairly high commodity prices, have quite a lot of cash on the balance sheets, and managements who don't really want to not have a job anymore and quite like their salaries, so they want to spend that cash. And a lot of them are looking to spend it in Southeast Asia, which is, I think, sensible from the perspective of that Asia is somewhere where there are opportunities. There's lots of drilling going on. There's lots of assets to go after. I think it's also quite high risk strategy because the best assets in Asia are held by NOCs and IOCs. And a lot of the stuff that there is to go after doesn't always have high asset quality. So, yeah, anyway, that's broadly what I'm seeing.